How's it going, everyone? Welcome back to another dividend investing video. While January saw stocks rise, February has showed us there's still much uncertainty ahead in the market. Now, as of February 26, 2023, the S&P 500 is up 4% year to date, but has dropped about 1.5% in just the last week. A lot of great stocks have dropped over the course of February, and we are seeing some better deals than where we were just a short month ago. Today, I want to share 4 dividend growth stocks that I think are compelling opportunities for long-term dividend growth investors. I'm talking about the folks who are building up their passive income and stacking dividends. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. All right, before I get into the stocks I like this month, let me justify my investment thesis for this group based on some criteria. First, I'm looking for a PE ratio to be lower than its 5-year average. Second, I'm looking for a dividend yield that is above its 5-year average. Now, I don't chase yield. I don't really care what the yield is, whether it's 1%, 2%, 3%. This is just a relative comparison to itself. Third, I want at least 7 years of dividend growth. Next, I want a 5-year average annual growth rate of 5% or better on their dividend. And finally, I want a dividend that is well covered by earnings and free cash flow. Those are my criteria. As always, I recommend you do your own research. Now, folks, there is a link in the description that will get you a discount on Seeking Alpha's premium membership. It's been available for $99 for 1 year all throughout February. I don't think that deal will last too much past February, but you'll still be able to get it at a significant discount to what you would otherwise if you use the link in the description. It's for our members of this channel. It is a way you can support our work here. I do a lot of my research for our videos on Seeking Alpha. So let's get into it. Our first stock is Dominos Pizza, ticker DPZ. Domino's is a multinational pizza restaurant chain with nearly 20,000 stores globally in over 90 markets. They have seen explosive growth over the last decade. On February 23rd, Domino's announced it was raising its quarterly dividend by 10% to the joy of dividend growth investors. This is one of the few food stocks that didn't cut its dividend and isn't named Starbucks or McDonald's. Their fourth quarter earnings did come short of expectations, and they are lowering expectations on their global retail sales growth over the next couple years. Domino's is down year-to-date 12%, most of that here in that last week on a drop after that earnings call. Now, for a guy like me, a company like this dropping 10% after announcing a 10% dividend raise is exactly what I like to see. Now, over the last year, the stock is down almost 29%, and as of the publishing of this video, Domino's is sitting at its 52-week low, just under $300 per share. Shares of Domino's are trading at a PE of 22.4. This is 24% below its 5-year average of 29.5, and it's about as low as it's been for the last 5 years. Criteria 1, check. Shares of Domino's are available at a starting yield of 1.63%. This is 83% above its 5-year average of 0.89%. This easily meets our second criteria, and it's not been possible to get Domino's at this kind of starting yield ever. Now, the last dividend raise put Domino's an uninterrupted dividend growth streak at 9 years, meeting our third criteria. And with a 20% average annual dividend growth rate over the last 5 years, that will check off criteria number 4. That is fantastic dividend growth. And for our final criteria, the dividend makes up 37% of both forward earnings and free cash flow. We like to see this below 50% for restaurants. Looks solid. Simply Safe Dividends rates Domino's with a safety score of 55, borderline safe. Now, the dividend of $1.21 quarterly is paid out in the months of March, June, September, and December for a total annual payout of $4.84. Have your shares by March 14th to get that next dividend payment on March 30th. Domino's is buying back shares every year at an aggressive rate. We had 57.7 million shares outstanding in 2013, and today we have 36.1 million shares outstanding. Love that combo of dividend growth plus strong buybacks. Those are my favorite types of companies to invest in. Now, Wall Street analysts generally like this stock, rating it a 3.75 out of 5, a buy. Out of 32 analysts, 11 rate it a strong buy, 4 a buy, 15 a hold, and 2 a sell. The average analyst price target is $363.88, which represents 22% upside from where it sits right now. One concern I have with Domino's is their debt. Really, it's my biggest concern. They typically run highly leveraged, but the difference now is the interest rates are considerably higher than they have been, and they will be paying a lot more in interest. And as an investor, you don't like to see that. Now, lots to like about Domino's. You have strong revenue growth, buybacks, double-digit dividend growth, and their pizza isn't too shabby either. Company number 2 is Union Pacific, ticker UNP. Now, last week we talked about CSX in a video on dividend raises, and last month we highlighted Norfolk Southern as an intriguing looking stock. But this month I'm focused on my favorite railroad stock, and really one of my favorite dividend growth stocks overall, UNP. As I mentioned in my weekly dividend recap series the other day, I think the railroad sector is appealing right now due to a lot of the headwinds and the fact that these companies have such serious moats. Rail is an efficient and cheap means of transporting cargo. Now look at this map. UNP has coverage of 2/3 of the United States, being a major player in American supply chain. Now, shares of Union Pacific are down about 6.5% year to date, and they're down nearly 20% in the last year. I'm happy when this stock dips below $200. That's usually when I like to beef up my own position in this one. Now let's check UNP against our criteria. Now shares of UNP look attractively valued at a PE of 16.7. This is an 11% discount to its 5-year average of 18.9. Criteria 1, check. We have a dividend yield of 2.68%, and this is 27% above its 5-year average of 2.11%. This is an appealing starting yield for a stock that is often yielding under 2%. So criteria 2, definitely check. Union Pacific has a dividend growth streak of 16 years, meeting our third criteria, and with an average annual growth rate of 15% over the last 5 years, that meets our fourth criteria. Love this chart. As for the safety of the dividend, it's covered easily by 45% of forward earnings and 55% of forward free cash flow. Both of these fall under the ideal level of 60%, so criteria 5 is met. Simply Safe Dividends gives us a safety score of 88, very safe. Now, Union Pacific shares the dividends paid out in the months of March, June, September, and December, the amount of $1.30 per quarter for a total annual payout of $5.20 per share. Here in the next month or so, we should be hearing about their next dividend raise. Now, UNP's buyback track record is as impressive as its dividend growth. We had 932 shares outstanding in 2013, and today there are 624 shares outstanding. Wall Street analysts rate the stock a buy overall with a rating of 3.76 out of 5. Out of 30 analysts covering the stock, 10 rated a strong buy, 4 a buy, 15 a hold, and 1 a sell. The average analyst price target is $219.89, representing a potential 13% upside from the current levels. Now, a lot of you have been asking me about this stock lately as it's been dropping, and in my opinion, it's very difficult to find a company that matches what Union Pacific does in terms of dividend growth and share buybacks. It's an extremely investor-friendly company. They even send me their investor calendar every year, and this is what I have up on my wall. It has trains, the American West, and dividends. What's not to like? So I've been asked for ways to support the work we are doing on this channel, so I've created a couple ways you can do so. I am a single father who does this in my spare time, and I work full time. The first, I made an account at buymeacoffee.com where you can buy me a coffee as a way to support the channel, and you can find a link in the description. Personally, I'd rather use your money to buy dividend stocks, but if you want to support my work in this way, it is much appreciated. And second, much of the data here I get researching from the website Seeking Alpha, and I've partnered with them to bring you a wonderful offer for 50% off your first year of their premium membership. This comes out to about $12 a month, and I think it is a great value for all the information you're getting on Seeking Alpha, as well as all the excellent articles. This site is instrumental in my research to produce the content I do for you guys. You can use the link in the description to get 50% off, and this is a great way to help support the channel. And finally, you can help me out tremendously for free by simply liking this video and making sure you are subscribed. Thanks again. All right, the third company we're looking at today is Essex Property Trust, ticker ESS. Essex Property Trust develops and manages multi-family apartment communities located in West Coast markets such as San Diego, the Bay Area, and Seattle. Investing in Essex gives you the ability to act as a landlord for an impressive portfolio of properties in some appealing markets that have plenty of room to grow. Shares of ESX are up year to date about 8.5%, but still over the last year the stock is way down about 27.5%. And it's still not very far off from those 52-week lows. In terms of valuation, ESS is trading at a price to adjusted funds from operations of 17.3, a significant discount to its 5-year average of 22.0. Criteria 1, check. Remember, for real estate investment trusts, we don't look at PE, we look at price to adjusted funds from operations, AFFO. Shares of ESX are trading at a 4% yield. This is 34% above its 5-year average of 3%. Criteria 2, check. ESS has announced 29 consecutive dividend raises, with its latest announced just last week, as we mentioned in our weekly dividend recap. Criteria 3, check. The dividend grows at a rate of 5% annually over the last 1, 5, and 20 years. Very consistent, meeting our 4th criteria. The dividend makes up 70% of forward adjusted funds from operations. And as usual, REITs are a little different than your average dividend stock. 70% is really actually low for a REIT. There is more room here for dividend growth. Now, Simply Safe Dividends provides us a safety score of 93 for Essex Property Trust. Very safe. Essex pays out its non-qualified dividend on a quarterly basis in the months of January, April, July, and October in the amount of $2.31 per share for a total annual payout of $9.24 per share. Have your shares by March 30th to get the next dividend payment on April 14th. REITs often issue shares to raise capital, but this hasn't happened really since early 2015, so again, this looks really good for a REIT. Essex is covered by 25 Wall Street analysts. 5 rate the stock a strong buy, 2 a buy, 15 a hold, and 3 a sell. The average rating is 3.36 out of 5, a hold. Essex has an average analyst price target of $245.62, representing 7% upside from where it stands today. Combine that with its 4% yield, and you could be looking at a potential 11% return in the next year. I think this is one of the stronger REITs in the residential space, and there's going to be a future video going more into detail on this subsector of REITs. I think it's really an interesting time to be in this sector. So the last company on the list today for stocks to buy in March is none other than Johnson & Johnson, ticker J&J. J&J needs very little introduction to a dividend investing audience as one of the greatest healthcare and dividend-paying companies of all time. They have 3 segments of their business: pharmaceuticals, med tech, and consumer health. The consumer health segment will be spinning off into a new company called Kenvue at the end of 2023. Their portfolio of products are well known and probably in your own household, like Listerine, Tylenol, Band-Aids, Zyrtec, among many others. The dividend policy should remain unimpacted with the spin-off, so this could potentially be similar to what we saw a decade ago with Abbott Labs spinning off AbbVie, and the result was 2 great companies. I'm highlighting J&J this month because shares are down over 12% year to date. There is some concern around lawsuit exposure, but J&J has been dealing with lawsuits for over a century. That's something to always be aware of. Shares are close to flat if we zoom out to 1 year. J&J is now sitting around that 52-week low. A dividend king with this consistency at a 52-week low is always worth our attention. But let's check against our criteria to make sure. J&J is trading at a PE of 14.8, while its 5-year average is 16.6. Criteria 1, check. Today, J&J can be bought at a starting yield of 2.9%, which is 10% above its 5-year average. Notice this is not a very volatile stock, very consistent. Criteria 2, check. With 60 years of dividend growth as a dividend king, no question that meets our 3rd criteria. And Johnson & Johnson has one of the most consistent dividend growth rates. You gotta admire the straightness of that line. At an average annual growth rate of 6% per year, easily meeting our 4th criteria. We have an earnings payout ratio of 43%, which looks great. Free cash flow payout ratio is at 68%, and that's a little bit higher than it's been. Not too bad, really, but hopefully they'll get that back under that 60% mark after the spinoff. But criteria 5 is easily met. We have a Simply Safe dividend safety score of 99. Very safe. This is one of the safest dividends available. Johnson & Johnson isn't one of those companies that buys back huge amounts of their stock, but the shares outstanding are on an ever so slight decline over the last decade, and that's great. We are not being diluted as shareholders. Wall Street analysts rate the stock at 3.57 out of 5, rating it a buy, 5 rated a strong buy, 3 a buy, 12 a hold, and 1 a sell. The average analyst price target is $180.90, representing 16% upside from current levels. I'm sure I'll get some shit in the comments for picking J&J this month just because it's so well known and everyone talks about it. But stocks like this are popular for good reason, folks. And this is about as good an opportunity as we've had in J&J in the last 2 years. I think this is one just about every dividend investor owns. And you have to love the reliability of Johnson & Johnson. Okay, let's quickly go over some additional stocks I think are worth adding to your watch list for the month of March. First, let's talk about Pfizer, ticker PFE. It's dropped 18% year to date. Like Johnson & Johnson, pharmaceutical stocks have really taken a hit in 2023 so far. This has brought Pfizer's yield to just under 4%, hanging out at its 52-week low. Looks like a deal to me. Didn't quite meet my criteria I set for the video based on its lower dividend growth rate, but I do see a lot of value here, and the dividend is quite dependable. Next, I still think Kroger is looking very attractive for long-term dividend growth investors. We're talking about double-digit dividend growth, and in the consumer staples sector. Every one of us needs to go grocery shopping to some degree. I've been buying Kroger in our public portfolio, as well as in another one I have, and I'll continue to do so as long as it's at these prices. I think this is highly underrated. This one meets all the criteria for this video. My next bonus pick is CSX. They're a competitor to Union Pacific we mentioned in this video. I think UMP is a higher quality company, but I mentioned CSX in a video last week and they raised their dividend by 10%. As I said, I think this industry as a whole is looking really appealing right now. If you want an alternative to UMP or maybe a complement to your UMP position, I think CSX does have a lot of appeal. This is an eastern U.S. railroad while UMP is on the west, and I think these guys will have some short-term issues because of what happened with Norfolk Southern, but without the actual consequences that Norfolk is dealing with as a result of the unfortunate incident in East Palestine a few weeks ago. Finally, I want to highlight automatic data processing, ticker ADP. Down 6% year to date, this is really a fantastic dividend growth stock that met all of my criteria, although not quite as much of a discount as the others I mentioned. We have a starting yield of 2.25%, coupled with double-digit dividend growth, and it's possible that this is the company that ensures that you get your paycheck. So check them out. I hope you all have a wonderful March. Drink some green beer on St. Patty's Day if that's your thing, but keep stacking those dividends. And if you don't feel comfortable investing in individual stocks that are just getting started, you can always buy SCHD or an S&P 500 index like VOO. It's a great way to get started, guys. Please follow me on Twitter at DivGrowthIncome. We have a wonderful community of folks who love dividend investing. Everyone's real kind, helpful, not really any egos. Please do all the things that help me grow my little channel here so I can keep making my amateur dividend investing videos. And I do hope you find some value in these. And until next time, keep investing.